I hear people talk about alignment of interests also, and it's almost become like a marketing term. Like it's lost the gravity that I think it should have. But I want to take a step back and explain alignment of interests. One, I'm reminded of a Nietzsche quote that's always really resonated with me. He said, "I don't believe in trust. What I believe in is mutual self-interest." And it kind of, hit me like a ton of bricks because it sounds cynical on its face. But when I started this business, I immediately said to everybody that I'm not going to be in the fee business. I'm going to be in the performance business. And people have said this to me a lot. And the only way that I can show our clients that we're truly aligned is, one, I have 100% of my net worth in my business. So my entire future for my children is in this business or in the deals that we're doing. One. Two, I'm not rewarded for capital raising. I mean, we don't have, like, are there third-party costs of capital and things here or there? Sure, but Ari personally doesn't take acquisition fee, disposition fee, or even a management fee, meaning for us to actually create alpha, actually create profits beyond a preferred return hurdle is the only way we make money. So how more can someone be aligned truly that's saying the only way I make money is if I make you money first? So we built an alignment of interest into the inherent structure of how the investments actually operate. You win, we win in that priority. You get your money back first, you get your accrued or paid preferred return, and then there is some split of the profits thereafter, and that is how we are rewarded. So you don't need to trust me, you just need to read your documents to know that we are truly aligned. So IRR, or an internal rate of return, I believe is an antiquated mode of actually looking at an investor's return. Because yes, it takes in time, which I like, and how much return you're making on a timely basis, which I think is important. But a lot of these deals, IRR can become skewed. And I can give you an example. If you buy a piece of land, you rezone it and you increase the value exponentially and you refinance and return that money to the investors, your IRR becomes infinite. So IRR on a multifamily investment is very important because how much cash flow are you getting? When are you selling? What are the multiple inequities? But when you have deals that are going through development cycles where you're selling off certain parcels, you're refinancing, you're returning some equity, or you're allowing some investors to come out sooner if they want to, the IRR ends up becoming a number that's difficult to gauge true performance. I believe looking at your multiple on equity and the conglomerate cash flows on an absolute basis really shows the returns that you're actually getting, and shows also from a risk-adjusted return standpoint, you can then gauge that absolute return against other benchmarks to see actually how you perform when you trade liquidity for returns. Because that's the other thing people don't talk about is, real estate in this manner isn't a liquid investment per se. So if someone's tying up your money and you don't have immediate liquidity, you better be outperforming the market, or they could be getting, a smaller return, but having a liquidity and having safety in an index fund. So when you take all of those things together, you begin to understand, where the return and where the expectations truly should be. Real estate, back to this liquidity issue, you're trading liquidity for returns. And that's how it should be looked at in a vacuum, is saying, if you're going to have my money tied up for 2 years, 3 years, 4 years, first of all, I don't like money to be tied up longer than 3 or 4 years, because since I'm not making money on the front end, I'm not running a charity, I'd like to actually build these, sell them, and get paid myself. So back to that kind of alignment of interests, like we're sitting on the same side of the table. But with that said, on a 3-4 year run in the markets that we have with the macroeconomic indicators, what's happening in Texas and these other growing Sunbelt cities, you should be looking at a multiple on equity. Are we flippers? No. Are you getting it in 6 months to create some, short-term capital gains tax? Absolutely not. But on the 2 to 3, 4 year range, if you're beating benchmarks, looking to double your money, and again, nothing's guaranteed. You go get hit by a bus, right? But the expectation and what we are looking to do on a gross basis is to at least double the equity every 3 to 4 years. And if we can double it in the 4 years, you make your split, we make our split, everybody's happy. Does it happen like that always? No. Sometimes it's more, sometimes it's less. But that's why I always encourage people to do multiple investments. And even in looking at funds, with a lot of time get a bad rap, but a fund in the correct structure is an impeccable design because it is inherent diversity. So if something sells earlier, something goes down, something goes up, we're not cycles. I mean, Forbes called me the Oracle of Austin, which is looking like we're pretty psychic, but I just believe, we can read the numbers better. I just think we understand the data, better than a lot of other folks are. But I'm sure it's certainly an expectation that I'm comfortable with, knowing the disclosures and knowing that things could happen on a 3 to 4 year basis, getting all your money back and looking at a multiple. I think that's absolutely within what our track record has shown, exiting over 60 buildings over the past, close to a decade. That those numbers are to be expected. And if you don't feel that you're going to be making returns like that with a good downside protection, as I've told you before, my first objective is always don't lose money. Making money will always be secondary to me, but I feel like if you understand the downside properly, it increases the probability of making money on the back end. I think the most important thing about alignment of interests is seeing the skin that your manager has in the game. I think that's the question. Whether you do business with us or do business with anybody else, what I want to know as an investor, are you invested in this deal with me? Like, do you have money in it? Do your kids have money in it? Like, are you just being rewarded for capital raising? So if you tell me a great story, which is part of the dog and pony show, it's okay. You have to share people with what the vision is, but are you doing that with an element of salesmanship that supersedes the value? And by eliminating those discussion points and really saying that we make money when you make money after your money is returned, I think that ends the discussion.